Welcome, everyone. Welcome to BMO's discussion on reciprocal tariffs. We'll be discussing the economic and market impacts. I'm thrilled that everyone could join us today. As many of you know, on April 2nd, President Trump unveiled the administration's much anticipated reciprocal tariff plan. While granting Canada and Mexico a much welcome reprieve, the White House's new global baseline and reciprocal tariffs were much larger than expected. Accordingly, we wanted to bring together two of our experts for a quick 30-minute discussion on how BMO is seeing the impact on the economic market and markets broadly as well. I'm Mike Miranda, head of investments for BMO Private Wealth across North America, and I'm honored to be moderating today's discussion. 30 minutes will go quickly, so let's get started right away by introducing our panelists. We have Michael Gregory, Managing Director and Deputy Chief Economist at BMO, as well as Young-Yu Ma, Chief Investment Officer at BMO Wealth Management U.S. And to start, I thought what would be most useful would be if we had Michael and Young-Yu provide high-level overviews on how they're seeing the impact of the latest tariffs on either the economy or the markets broadly. And with that, Michael, why don't we turn it off to you to kick us off?
All right. Well, thanks, Mike. I appreciate that. Listen, we've all been following what's been happening since Wednesday evening, and we've seen a lot of commentary, a lot of talking heads, including myself, on the impact of these tariffs. Something we have to keep in mind, though, is that and a lot's been made on the so-called formula of how these tariffs were devised. And we were promised a tariff that would offset the impact of tariff and non-tariff barriers that U.S. businesses were facing in their global markets. Instead, we got a calculation, a very simplified calculation of how much tariffs would have to go up to increase import prices faced by U.S. consumers and businesses enough so that their demand would fall enough to eliminate the trade deficit. It's still a legitimate calculation, but it's far from what it was intended to be. Now, true that the tariff rate that's going to be applied is half that, and of course, on top of that, we do have the global baseline tariff as well. And we will see in the next few weeks, days, months, maybe exactly how much of this gets renegotiated away. The baseline probably not, but the bottom line for the U.S. economy, particularly, we've gone now since February-ish with a average tariff rate that was under 3% to something now that's pushing 20%. And that may roll back a little bit depending on what kind of negotiations go on, but it's a meaningful increase that will have a huge hit on the economy. And as a consequence, we have downgraded our forecast for the U.S. We shaved growth last week by, we're going to look at things on a fourth over fourth basis because that's where you truly see the impact of the revision. We lowered growth by 0.8 of a percentage point down to 0.6%. And we actually raised inflation, core PCE inflation, the kind of inflation that matters most for the Fed. We raised that by 0.8 of a percentage point to now 4%. Remember, folks, that the Fed's target is 2, not 4. And this puts the Fed in a very a worrisome dilemma. This is clearly a stagflationary impulse for the U.S. economy. And as a consequence, the Fed's going to have to sit back. And as Chair Powell indicated on Friday, we'll have to wait and see what breaks first. Once those tariffs come through, do we see any second round or impacts from them? We'll have to wait for that. Meanwhile, at least from a payroll perspective, things looked okay on the latest job reading, but we'll have to see how that unfolds too in the months ahead. Now, keep in mind that Canada, as you mentioned, Mike, did get off, so did Mexico. But that's not to say that things aren't great on the tariff front. Last week, the global tariffs on automobiles kicked in, and while there's a little bit of a carve out for U.S. content if you're USMCA compliant. And the fact is that's going to hurt Canada, as are those broader tariffs on goods that are not USMCA compliant. We have the steel and aluminum tariffs, and so there's a lot of tariffs that have built upon the economic forecast, and as a consequence, if we go back, say where we were early March, things have really been cut meaningfully. For Canada, we've gone down from 1.6% growth to now having on a fourth basis minus 0.7. That's a recession in Canada. We've got about an 0.8 increase, in inflation. In the U.S., much stronger inflation than that. We have it going up from 2.5 up to 4, and growth not as bad, going down from 2%, which we were before, to the 0.6 I mentioned. The key thing to mention here is that this is hurting Canada more than it's hurting the United States. But it's hurting both, and I say that's the bottom line. And in terms of the inflationary impact, it's kind of hurting the U.S. more than it is, say, for Canada. And a couple reasons for that. One, we got a weaker economy in Canada, therefore that puts downward pressure on prices. And the second thing is that we are going to get the benefit from lower energy prices because of the removal of the carbon tax. So, like any kind of trade wars, no one wins from this. And we're just going to have to see over the next weeks, next few months, how this unfolds. And I'll leave it at that for now.
All right. Thanks, Michael. Appreciate that. Great backdrop there, and certainly great to give us your perspective on the updates to both growth and inflation for both the U.S. And Canada. I'll have some more questions for you, certainly, as its impact longer term and the like in a bit. Why don't we bring in Young? Young, would love, given the backdrop that we've outlined here, your thoughts on its impacts on markets. Obviously, it's been pretty significant over the last few days, but would love to open it up to you. Same kind of opening thoughts on what this has done for markets and thoughts more broadly.
Yeah, thanks, Mike. Absolutely. As Michael Gregory said, these tariffs were anything but reciprocal, and the extreme nature of the impact of the tariffs was clearly felt in the stock market. We had 2 days in a row in the U.S., both Thursday and Friday, where the single day decline in the stock market was greater than the stock market's decline on the day of the Lehman bankruptcy. So very significant declines, very big surprise, the biggest type of drawdowns, multi-day drawdowns we'd seen since the early days of COVID. And it's that type of shock that has reverberated through the system here. As Michael said, these are very significant, and these do have an impact on growth. They have an impact on inflation, even if they stay in place for just a modest amount of time. And I do want to talk about the timing aspect of this as well. But part of the issue, as Michael said, is the U.S. is hurting, Canada's hurting, but it's not just the U.S. and Canada. The U.S. is having a trade war on many fronts here. And of course, there's what looks to be even potentially more escalation with China, tariffs on imports from Asia, tariffs imports across the globe. So this is a lot to take on at once for the U.S. economy. It's like fighting a war on in almost dozens of fronts at once, which is very difficult to sustain. Our beliefs in terms of what we're thinking of are a few things that are very important right now. One is how long these tariffs actually remain at these levels. So if it's the case that after 4-6 weeks, we start to get meaningful negotiations where these tariffs with the individual countries deals are struck, where they come down, not just come down, but come down to levels which are more consistent with stabilization, both in the U.S. and globally. That would be, say, a 10 to 15% level. For many countries that might be at 25, 30 now. If they come down to that level, that's over that time period, that's a good development. If this takes more than, say, 6 to 8 weeks to get meaningful negotiations, or if we get negotiations where the tariff levels just don't come down all that much, Vietnam, say, it comes down from 40, mid 40s only to 25, 30%, or Japan goes from mid 30s to only 20, 25%. Those would still be extremely significant tariffs and causing extreme growth and inflation shock to the U.S. So there are two things at hand, both the speed at which deals happen and what's the actual nature of those deals. One thing we're focusing on very intently is what is the extent of the Republican congressional pushback in the U.S. to tariffs. It is very important to note that tariffs are not traditionally part of the Republican platform. Republicans are traditionally anti-tariff and more free trade based. So to the extent that we have a very slim majority, the Republicans have a very slim majority in the House of Representatives, that pushback could be very significant. There are also legal challenges to President Trump's use of emergency powers to enact tariffs. And even conservative legal scholars are saying that this legal argument is very sound, or at least has potential to gain traction, even all the way up to the Supreme Court to challenge the use of emergency powers. So there's a lot in play now between negotiations, potential escalation, a timeline that we're looking at that things need to happen relatively quickly before these more negative effects start to build down momentum, and also legal challenges and Republican pushback. So there's a lot in play we're looking at now. It's an extremely uncertain environment. That's what the market has been reflecting, that extreme uncertainty, to have the type of shocking days, which are very similar to the early days of COVID in terms of the multi-day extent of the decline here.
Thanks for that, Young. Very, very helpful. And I'll come back to you certainly with thoughts on how we should be thinking about the market on a go-forward basis. Let's go back to Michael again. Michael, I know there's a lot of discussion about potentially the timing mismatch, any long-term benefits from tariff negotiations versus near-term pain. I want to probe a little bit on that latter point. How soon, from your perspective, should we be looking to see any of this pain on the U.S. economy? You obviously gave us perspective on your downward forecast for growth and upward impacts on inflation, but would love to probe a little bit on the timing there. All right, well, let's pivot. We'll come back to Michael. Maybe he's having some technical difficulty. Young, let's come to you then. You're talking about the market volatility, for sure, the acuteness over the last few days. I want to think about, from your perspective, what's priced in maybe into the markets right now? Is it looking at kind of a prolonged trade tensions, and how do you expect that volatility to unfold over the next few quarters and maybe through the balance of the year?
Yeah, that's a great question. What's priced in both in the U.S. and Canada, here in North America, to the markets? President Trump instituted a 10% baseline tariff that applies across the board. And in addition to that, all the numerous and dozens of country-specific tariffs. I would say if we think about what the impacts are and how much the market has fallen, probably something that would be akin to a 15% across-the-board tariff is priced in now. So a medium level of difficulty and stress in the marketplace, I would say, is now priced in and into the economy, and a medium amount of slowdown and a medium amount of inflationary pressures. The most extreme scenarios, I would not say, are priced in at this point. But also, what's not priced in are more positive scenarios. So I think we're at this medium priced in level. Markets have corrected a substantial amount. If there are more extreme developments that take place in the coming weeks and months, it could still be a volatile path ahead. But if we do get some of those positive developments, including congressional pushback, which would be an early sign or early signal that there could be more deals struck and more traction for legal challenges. If we get some of those, in addition to potential deals and the nature of those which look more favorable, with pressure on the administration, I do think it's going to be acute. So to sum it up, I think we're in a middle phase now of what's priced in, and things could go in a positive direction. They could also potentially go in a more negative direction if this tariff regime looks to be as aggressive or nearly as aggressive as the initial indications would point toward.
All right, thanks for that, Young. Let's see if we can bring Michael back in. Michael, I just wanted to go back to that original question, which was about the timing of the impacts on the U.S. economy first. So you talked about obviously downgrading growth and increasing inflation. How soon will we see those hits start to impact the U.S. economy? All right, it looks like we're still having some technical difficulty. That's fine, we'll pivot. Sounds good. Young, let's stay then on the markets. Today is one of the most volatile days that we've seen, right? And I think it's reflective of some of the volatility that has transpired over the last. We had yesterday markets down 5% overnight, down 4 or 5% at the open, go all the way to up 2 or so percent on hopes that tariff relief would happen, and then back down again. So a lot of volatility. Some of it is on the negotiating path that you talked about, and some of it's on maybe the Fed and central banks coming to the rescue. How do you think about that? We obviously have the fiscal side with tariffs, but we have the monetary side with the central banks. Do you think they will come to the rescue in this backdrop, or where do you see central bank policy going?
Well, I'll focus on the Fed because I do think ultimately the U.S. is probably going to be a big driver of how the global markets start to take direction here. I don't think the Fed is going to come to the rescue anytime soon. It's going to take some weakening of the labor market. The Fed and Chair Powell's comments just last week leaned actually a little bit hawkish in terms of indicating that it's possible these inflationary impacts from tariffs might be longer lasting than originally messaged by the Fed. So that's shows some concern on the inflation front. The Fed has a dual mandate: price stability, but also maximum employment. So you'd have to see some more weakening of the labor market for the Fed to have enough cover to start reducing interest rates again. With rising inflation, the Fed is not apt to go against that part of its mandate unless the other part of its mandate, the maximum employment, starts to weaken. The Fed is not going to come to the market's rescue just to save the markets unless it becomes something much more acute than's happening today, or to the economy's rescue. The Fed's job and the Fed's job description is not to save the markets. So the Fed needs to see weakening in employment, which we have not seen yet significantly. There are some signs under the hood. Temporary employment is weakening, job openings are weakening. Until that starts translating or at least permeating more of the labor market data, we wouldn't expect the Fed to cut rates. But if we take a step back and think about the impact of these tariffs, it certainly would be the case after 2 months, these tariffs, if they stayed in place even near the degree to which they're in place now, that we would expect weakening of the labor market, and that could give the Fed some cover by midsummer to start lowering rates. So it could be that time at which the Fed starts to lower rates. Let's say that's midsummer, if there's labor market weakening, which I think there would be. But the Fed's not going to come to the rescue next month. It's just not going to happen. And so the labor market weakening combined with what could then be deals are in the works being struck, maybe some walking back of tariffs, maybe legal challenges actually by that time having sort of worked their way through the legal system and tilting in one direction or another. We do still believe it's quite possible that 2 months from now, let's say by mid-June, that there could be a lot more resolution than there is today. It's hard to see that today, but there's a lot in play that could move very quickly.
All right, thanks for that, Young. Let's try Michael again. Michael, I know we were having some technical difficulties, but hopefully you're back. Let's try one more time.
Let's hope so.
All right, there we go. So the question that we had started with, Michael, was just this push and pull about the long-term benefits, but more I want you to talk about the near-term pain, if you will. And obviously you've lowered your growth and increased your inflation forecast for the U.S. How soon do you expect that to start showing up in hard data and in just observations in the U.S. economy?
Yeah, sure thing. And I apologize for that little technical problem. All right, so let's keep in mind the reciprocal tariffs kick in on Wednesday, so they're not even enforced yet. And the global baseline tariff only started on Saturday. So, those are still working their way through. And I would expect in things like food, and perishable type goods that with a high frequency imports into the U.S., you'll start to see the impacts of that right away in terms of an inflation standpoint, or at least a price level standpoint. And keep in mind, last week we had an increase in tariffs on imported vehicles. That will show up in next month's CPI on new vehicle prices, and we start to see some layoffs more in Canada and Mexico in the auto sector, but some actually rippling through into the U.S. economy, and those will start to show up as well in some of the payroll numbers going forward. So we're starting to see the impact now. And it'll start to show up increasingly in the numbers. And the question, as Young kind of mentioned, for the Fed, they've got both an inflation impulse and a sort of a lower growth impulse. Which one shows up first in terms of how the Fed responds? And I think they're going to get a mix of both, again, making their job even more difficult.
Yeah, difficult for sure. Let's stay with you, Michael, because I did want to follow up maybe on the economic backdrop. You lowered growth in both U.S. and Canada. Do you think it's kind of a fait accompli that we actually are going to have a recession here? And what are you looking at to try to determine whether we actually have a contractionary economy?
Sure. Well, our base case, even with the tariffs as they are fully revealed now, is not for a recession in the U.S. I think there's about a coin flip's chance of it happening. Now, we will get a little bit of rollback, I suspect, from those negotiations. But at the same time, we have new tariffs that are coming on at copper and lumber for sure, and potentially some other sectoral tariffs as well. So we give up some of that, and then we sort of get some. So that clearly is a problem for the economy.
Yeah. Well said. So, Young, let's go back to you then, maybe about the markets. I know many of our clients on the call here are thinking not just about the economic backdrop, but also about the market impacts. How would you be thinking about portfolio positioning in this environment? You talked just a bit ago about the scenarios of markets going down, but also markets could potentially snap back if we had some resolution here. So talk to us a little bit about portfolio positioning in this period of heightened volatility.
Yeah, it's an extremely challenging time for portfolio positioning because we're not dealing with the interplay of economic forces or traditional market forces. We're dealing very much with and completely with, I would say, a policy-driven impacts that could shift at any moment. And there are many factors in play, as I talked about before, whether it's with the congressional Republicans, with legal challenges, with other countries' willingness and propensity to make deals and where they come in at. We could get some shifts very quickly, either hopefully positively, but there could be some negative ones as well if certain sides dig in or we can't get those potential rollbacks of some of the more extreme tariffs. So there has been a flight to safety in the markets. That's something you certainly see when we have these type of extreme events. Flight to safety meaning core bonds, very high quality bonds, whether it's treasury bonds or double, AAA corporate bonds. Those have definitely garnered a lot of investor attention and flows in the past few days. And additionally, one thing we've seen is some sectors that are traditionally seen as safe havens, such as consumer staples, do well. Now, that effect is tricky, I would say, from longer term, even medium term investor standpoints. Trying to game or time specific sectors is quite challenging because if there is a change in some of these factors that are in play now that directionally impact where tariffs are going, then we could have an extreme reversal in some of these sectors that were previously thought to be safe havens if investors now want to go back into areas where they previously avoided or fled from. So I think the important thing to understand is now, other than these safe haven areas, you have a market where everything goes down, right? Just about everything goes down. Fortunately, I would say we're on the cusp of earnings season. We have very major companies, even this week, large financial companies starting to report earnings. We're going to get that accelerated into the next few weeks. And amid earnings season, we'll start to actually hear about companies. Yes, there'll be some impacts or concerns about tariffs, but we'll also hear some of the underlying aspects of the business and some things that companies do feel positively about as well, that I think is going to give a little bit more of a balanced picture going forward, rather than only the negative side that we've been hearing from tariffs over the past, since Wednesday, essentially, over the past week when it's been more acute. So I think there is some nuance in the messaging going forward. We don't want to make extreme moves in portfolios. There could be investors who found themselves with more risk than they're willing to take here, and some modest moves might make sense, but you don't want to sell into a panic. it almost never makes sense to sell into a panic. So we're not advocating wholesale liquidation into panics. That's almost universally a bad idea. Modest changes for those who have find themselves with too much risk, into core bonds and into safe areas of the market could be a consideration, but we don't want to make major changes when the environment is as uncertain in both directions as it is today.
Thanks for that, Young. Definitely good advice to balance out the risks in this kind of evolving landscape. Going back to you, Michael, just a question maybe about, as we think about resolution potentially or negotiations, there's obviously been a lot of discussion about is the administration open to bilateral negotiations? Are they not? There's potentially many countries that are in talks with the U.S. From your perspective, or maybe from an economic perspective, do you see those negotiatings unfolding over the coming months? There's also this push and pull between negotiation versus trying to raise revenue with these tariffs in place. So give us your thoughts maybe on kind of how you see it potentially unfolding.
Sure thing. Well, let's put it this way. From the get-go, the administration said that they were open for negotiation on the reciprocal tariffs. And so I suspect we are going to see that. The administration said that they have more than 50 countries, and there were 57 that got the reciprocal tariffs. So maybe some of those 10%ers are in that mix as well, that are going to have reached out, to the administration to see what they can negotiate. So I do think we will get some rollback of those numbers in the period ahead. But some things are non-negotiable. That global baseline tariff is going to be there. And this harkens back to the original America First trade policy memorandum that President Trump signed on Inauguration Day. And the first order of business of that trade policy was to investigate a global supplementary tariff. This idea that we needed that just at the beginning, this level the playing field. And it looks like they've got that. And that's not going to get back. And the whole slew of sectoral tariffs, they're not going to disappear anyway. So the tariff level is going to be high. And I just want to be one extra point, and just sort of in the previous question you asked about, the inevitability of recessions. There's something here that I think we have to sort of mention as well, is fiscal policy. There is a way in which that we can sort of offset any kind of drag on growth. Now, and sadly for the U.S., we're just struggling now to see whether or not our tax rates go up on January 1st, 2026. And despite a Republican flush of Congress, they have a hard time even passing that. Whereas in Canada, both the federal and at the provincial level, they're in pretty good fiscal shape. So I think what helps maybe to mitigate the downturn in Canada, recall, we aren't expecting a downturn in the U.S., but in Canada, is the fact that we'll likely get some kind of a fiscal response support for the most affected industries, and hopefully measures that actually try to promote growth and promote productivity growth, which are woefully weak in Canada right now.
All right, thanks, Michael. That's very helpful, especially to balance it out with the potential fiscal offset down the road. Realize we're almost at the hour, so maybe some closing thoughts from each of you. Young, let's start with you. Just some closing thoughts as to how you see the market unfolding over the balance of the year, and maybe more acutely over the next few months, and how our clients should be thinking about that market backdrop.
Yeah, I do think that looking and thinking about the balance of the year is still relevant here. I know it's hard to get past the immediate headlines, but there's so much uncertainty, so much in play, really navigating the headlines and that level of uncertainty is probably a near impossible task. But if we think about mid-year, end of year, how do things stand? I think that really trying to understand where that big picture is. Do we have tariff levels that are reasonable in terms of the economy being able to adjust to them and the markets being able to price them in at levels similar to where they are today, so that we can just move forward the business of doing business, and companies have clarity. Companies can understand where they want to invest, how they want to invest, and think about the path forward rather than thinking about how they navigate this environment of tariffs, reciprocal tariffs, retaliatory tariffs, and everything else going on. So I think that's what we're looking for. And it's important to understand that what are the markers of that? The markers are that we're getting to a bit of a softer path. The markers are going to be Republican pushback. The markers are going to be how these legal challenges play out. The markers are going to be how quickly and significantly deals can be struck, how much they actually bring down those quote unquote reciprocal tariffs. Those are going to be important markers to focus on. But we do think a fair amount is priced in now, a fair amount of the negativity, but there's still acute uncertainty on a day-to-day basis right now.
That's great, Young. Thank you for that. And I do appreciate those three markers that you left our clients with to think about over the coming month or so, and how we will see potentially any resolution. Michael, let's close out with you then. Similar to Young, any last thoughts that you would have, and things you'd like to leave our clients with as well, top of your mind, especially as it relates to the economic backdrop?
Yeah, sure. Well, listen, we know that maybe tariffs are not going to be as onerous as they seem to be right now. We'll get a little bit of a pullback in negotiations or whatever. But the fact of the matter is we're now in an environment, particularly through this reciprocal tariff, where I think most folks are pretty amazed just the lack of the maybe sophistication and the rigorousness of which these things went at. So there's a whole uncertainty about the direction of policy, not only on trade policy, but immigration policy, regulatory policy, broader fiscal policy. How is this all going to unfold? And as long as you have that uncertainty, even if you get a rollback in tariffs, that uncertainty does affect businesses, as Young said, in terms of how they're thinking about, investing in the future. So, yes, we want to create this tariff wall so there's more investment in America, but the people making that investment in America are people that are facing a lot more uncertainty, and they're thinking beyond the next 2 or 4 years in terms of making those investment decisions. And it's a very uncertain environment. So I do think we're probably in this period now. One of the legacies of protectionism is that you do get sub-performance of the economy, lack of productivity growth, lack of innovation, and we could be now on the cusp of such a profile.
Thanks, Michael. Well, appreciate your perspective, as always, on its potential impact to the economy. All right, well, 30 minutes we expected was going to go quickly, and it certainly did. We covered a lot of ground today, exploring these implications of what the tariffs mean, both for the economic backdrop and for the markets. Michael and Young, I want to thank you both for another insightful discussion. I think your analysis provided a lot of great, much needed context for our clients, and to our clients and audience broadly here. Thank you for taking the time out of your day to join us. There will be a video replay, a podcast, and an article following this event, which you can find on our websites. BMO, as you expect, will continue to monitor these developments. So I encourage you to reach out to your relationship manager for more details. And with that, I wish you all a great rest of your day.